Hey everyone, we've got a pretty big issue on our hands. That's probably what companies like Adobe, Salesforce, or Duolingo have been telling themselves lately. They are all from different industries, but there is one theme tying them together: the AI narrative. Negative, scary, almost like throwing in the towel. But is it really the end of the line? Let's cut out the emotions and look at what the numbers are actually saying, not just what's being discussed online. Take Uber, for example. The stock dropped 5% on Thursday after Waymo dropped some fresh news. And while we are on the subject of bad headlines, let's look at Nvidia. China has officially banned domestic firms from buying Nvidia chips, while Broadcom is actively eating into its market share. That's something worth digging into. Of course, there's plenty more happening. Amazon is expanding into another sector, one that isn't talked about much, but carries massive potential. Intel jumped nearly 30% in a single day after Nvidia announced a $5 billion investment into joint chip development. Google continues to pay out billions to its content creators. And then there's the $7 trillion sitting in money market funds, waiting to flow into the markets. So grab a coffee, get comfortable. It's time for another episode. Always good to see you back. Let's get into it. Looking at the last 3 months, it's clear that the most tech companies have been soaring, up 20, 30, even 50%. But then there is this smaller software application sector, home to names like Salesforce, ServiceNow, and Adobe. So why are these companies dropping during the biggest AI boom in history, while everything else rallies? Ironically, it's because of AI itself. The uncertainty of how it will impact them has spooked investors. Adobe is down about 33% over the past year. Salesforce has fallen over 34% from its heights. Duolingo is down nearly 50% in just 6 months. So the question is, will AI really erode their business models? When you look at Adobe's fundamentals, revenue keeps climbing, double-digit growth this year, and expected again in the years ahead. Earnings per share are up around 12% annually. Free cash flow, a steady upward march. Salesforce tells the same story. Revenue growth at 8 to 10%, EPS growth in double digits, and free cash flow margins sitting at 35%. Duolingo, explosive revenue growth at 36% last year, with another 20 to 25% expected. EPS projected to grow 30% annually, free cash flow up 30% as well. So the fundamentals are strong, yet the stock prices are down 30 to 50%. So what's the issue? Deep valuation. Adobe's price to earnings ratio is at 10-year low. Salesforce, same thing, lowest in a decade. The only expectation is Duolingo, still trading at a premium, around a 30 PE, but even that looks fair relative to its history. This isn't the first time we've seen this kind of a story. Meta dropped 70% in 2021 to 2022 because TikTok was supposedly about to destroy Facebook. What did Meta do? With billions in a bank and almost no debt, it adapted, copied its competitor, and then rebounded 600 to 700%. Google faced a similar narrative. ChatGPT was going to kill search. People wouldn't Google anymore. Google responded by boosting capex, investing in AI, leveraging its brand loyalty, and the stock has since rallied almost 70%. Uber was written off too. Tesla's Robotaxis were supposed to wipe them out. Yet Uber still has millions of daily users, plenty of tools, and today its stock trades at all-time highs. The lesson? Strong ecosystems and solid balance sheets often outlast the negative narrative. Whether it's Meta, Google, or Uber, the fundamentals usually win out. And that's how I see today's software names. Maybe I'm wrong, and maybe AI really will punish them, but history suggests otherwise. Time will tell. Now, Nvidia. Even with Trump's administration securing export licenses for the H20 chip, watching Nvidia sell to China as long as 15% of the revenue is handed back. Beijing has banned big firms like ByteDance and Alibaba from buying them. What I like is how Jensen Huang, Nvidia CEO, has handled it. Calm, measured, playing both sides. Heads off, that's a leadership.
This is what he said.
Every American technology company, for every American technology company, China is important to have. It's an important market. It's also, as you know, it's just really large. It's the second largest computing market in the world. I'm just delighted that President Trump sees the wisdom of American leadership, and particularly at this time where AI is taking off, it's vital that America wins the AI race.
Meanwhile, OpenAI, which has long relied on Nvidia's chips, is now diversifying. They just placed a $10 billion order with Broadcom, and OpenAI may not be alone. Meta, Alphabet, ByteDance, even Microsoft could follow. That could take some market share away from Nvidia. Still, despite these headwinds, Nvidia stock is basically at all-time highs. Back to Uber. It dropped 6% on Thursday, but by the next day, it had fully recovered. The bigger story was Lyft, which signed a new partnership with Waymo, Google's self-driving unit. That news sent Lyft stock up 17%. According to Goldman's Mark Delaney, this robotaxi market could be worth $58 billion by 2030 and potentially $330 billion. That's way too big for Tesla or Uber alone. Waymo knows it, and Lyft is now on the board.
People really like AVs. And this is not at all to say that drivers won't have a huge future in front of them as well. But it's great to have a new product that people find safe, find reliable. It knows the traffic laws, it follows the laws. Of course, it's quiet and kind of private in the car. So these things are things that people, I think, are going to like for a long time. And it's why we think that AVs are going to expand the market, wherever we go. We're actually seeing that in all the markets where we operate and AVs operate. Is our markets are actually growing faster than they are elsewhere.
Recent studies show why robotaxis could succeed. They are quiet, safe, almost accident-free, private, and make passengers, from seniors to kids, feel secure. This isn't a winner-take-all market. Uber and Lyft can both drive here, and the panic sell-off in Uber provided, vanishing within a day. Now let's shift to some positives. Amazon, the giant that dominates every industry it touches, is making new moves in healthcare. After acquiring Pillback, Amazon is now partnering with Fi, a telehealth platform. Think of it like Hims and Hers, but focused on nutrition. Fi connects people with registered dietitians for advice, coaching, and preventive care, often free of charge. Of course, there's upselling later on, but the key idea is this. Nutrition is one of the least used tools in preventing chronic illness. As Faith's CEO put in, nutrition should be just as easy to access as ordering from Amazon. Love that line. Meanwhile, Intel shocked the market, up 30% on Thursday after Nvidia's $5 billion investment into joint chip development for data centers and PCs. And just last month, the US government itself became an Intel investor. Nvidia's $5 billion came in at $23 a share, and immediately after the announcement, the stock spiked close to $33. As Jensen Huang put it, this historic collaboration ties Nvidia's AI and accelerated computing with Intel's processors and vast x86 ecosystem. Together, we'll expand our platforms and lay the foundation for the next era of computing. Sounds bullish, right? Intel may have a future, but let's be careful. Intel was called dead not long ago. For me, if you want to buy Intel, the time was before this announcement. Now it's more about taking profits. The deal still needs regulatory approval, and it doesn't seem to involve Nvidia manufacturing in Intel factories. But either way, interesting news, and congrats to those who bought at rock bottom. Another highlight. YouTube has paid over $100 billion to creators since 2021. Yes, YouTube is the most watched streaming platform, even ahead of Netflix. Creators' earnings, $100,000 a year, grew 45% year over year. That's $100 billion paid out in just 4 years. Massive. And of course, the Fed. They cut rates at 25 basis points, bringing them down to 4 to 4.25%. Markets didn't move much, since this was already priced in. But there was a disappointment. Many central bankers only see one cut next year. Powell made it clear. This move was about risk management, not boosting the labor market. The Fed had a tough job, and honestly, they probably did the best they could. We'll have to watch how inflation and the labor market develop. Ideally, inflation goes down, jobs go up. That's the sweet spot. Here is the kicker. Even at all-time highs, there is still $7 trillion in cash waiting on the sidelines. Investors have it parked in money market funds, collecting high-yield returns. This wall of cash is just waiting for rate cuts to be deployed into equities. So yes, valuations are high, and maybe we'll see a short-term correction. But looking a year ahead, I believe markets will set fresh all-time highs for the indexes and for our portfolios. And that's it for today's video. If you found this valuable, the best way to support me is by subscribing to the channel. Thanks so much for your time, and I'll see you in the next one. Take care.